What if I told you you don't need a high income? You don't need thousands of dollars. You only need $25 a week, because over time, that small amount could grow into over $800,000 and pay you $5,000 every single month. Most people ignore this idea because it sounds too simple. But the truth is, simple strategies are often the most powerful. Most people think the solution is, I just need to make more money. But here's the reality. You can make $5,000, $10,000, even $20,000 a month and still end up broke. Why? Because without a system, money flows in and flows right back out. The real problem isn't income, it's a lack of strategy. The strategy we're talking about today is called DRIP, Dividend Reinvestment Plan. And it's simple. Instead of taking your dividends as cash, you reinvest them. That's it. But that one decision changes everything. How DRIP works, let's break it down simply. You own shares of a company. That company pays you dividends. Instead of spending those dividends, you use them to buy more shares. Now you own more shares, which means you earn even more dividends next time. And then you repeat the process. This creates a loop. Money to shares to dividends, to more shares to more money. That loop is called compounding. Let's look at a simple example. Share price at $20, dividend at $1 per share. Starting shares 100. Year 1, you got 100 shares and $100. Year 5, you got 120 shares and $120. Notice, you didn't add more money here, but your income still increased. That's the power of reinvesting. Now imagine this visually. At the beginning, growth looks flat. Almost nothing happens. But over time, that line starts to curve upward, and then suddenly it takes off. That's compounding. And here's the truth. Most people quit right before that curve happens. Now let's make it even more powerful. Instead of only reinvesting dividends, you add $25 every week. That's $100 per month, $1,200 per year. Not a lot, but incredibly consistent. Why this works? Now you're combining three powerful forces: compounding, consistency, dollar cost averaging. You're buying regularly, whether the market is up or down. Over time, this smooths out risk and builds momentum. Long-term results. Let's look at what happens over time. Year 1, you've achieved $2,500, and year 30, you got over $800,000. Now here's the important part. At 30 years, you're not just holding money. That portfolio could generate approximately $63,000 per year, over $5,000 per month, without working for it. To make this work, you need the right types of investments: blue chip stocks, dividend aristocrats, high yield stocks, growth dividend stocks. Build a balanced portfolio. So, what are these stocks? Let me explain. Blue chip stocks. These are shares from large, financially strong, and well-established companies that have a consistent record of stable performance over time. Examples: Apple Incorporation, Microsoft Corporation, Coca-Cola Company, Johnson & Johnson, Walmart Incorporation. These companies are globally known, profitable, around for decades. Key characteristics: 1. Stable and reliable. Not too volatile. Survive recessions better. 2. Strong financials, high revenue, consistent profits. 3. Pay dividends. Many blue chips pay you cash regularly. 4. Trusted brands. People use their products daily. Strong reputation. Dividend aristocrats are companies that have paid and increased their dividends every year for at least 25 years straight. Examples of dividend aristocrats: Coca-Cola Company, Johnson & Johnson, Procter & Gamble, 3M Company, McDonald's Corporation. These companies have been paying investors for decades. Why they matter? 1. Consistency. They never miss dividends, even during recessions. 2. Growing income, not just paying, they increase payouts every year. 3. Financial strength. to increase dividends for 25 plus years. They must be profitable, stable, well managed. High yield stocks are stocks that pay higher than average dividends. What does high yield means? Average stock dividend, approximately 2 to 3%. High yield stocks, 4% to 10%. Example, you invest $1,000. 8% yield equals $80 per year. Common high yield companies: AT&T Incorporation, Verizon Communications, Realty Income Corporation, Altria Group. These often come from telecom, real estate, utilities. Why people like high yield stocks? 1. More income now. Bigger cash payouts, good for monthly/quarterly income. 2. Passive income strategy. Many investors use these to pay bills, replace salary, build cash flow. Growth dividend stocks are companies that pay dividends, increase those dividends over time, and still grow their business. Common companies are Apple Incorporation, Microsoft Corporation, Visa Incorporation, Home Depot. These companies don't pay the highest dividends, but they grow payouts fast over time. Why smart investors love them? 1. Best of both worlds. Income, growth. 2. Beats inflation. Your income keeps rising, not stuck like fixed income. 3. Long-term wealth machine. Over time, dividends grow, stock price grows, compounding kicks in. Here's the truth most people ignore. $25 feels small today, so they don't start. But wealth doesn't come from big actions, it comes from small actions, repeated consistently. So ask yourself, will you wait until you have more money? Or will you start with what you already have? Because one day, you'll look back and realize that small decision changed your entire life. Disclaimer: this video is for educational purposes only and is not financial advice. Always do your own research before making financial decisions.